based on an earning event. And eventually one of them will work. But the fact that it worked historically doesn't mean that it will work in the future, because this is really, without a causal model, you are doing blind search, and it is very often time that you get a selection bias. So to avoid selection bias is another important pitfall to avoid in backtesting. So the first pitfall to avoid is look-ahead bias. Is fairly easy to avoid if you know how. The second one is to avoid selection bias or data mining bias, or whatever you call it. That is more difficult. It's more subtle.
Can you talk to me a little bit more about what look-ahead bias really is?
Well, I mean, a lot of times, a very simple look-ahead bias, simple but subtle look-ahead bias is that, for example, some people wanted to do pair trading, and in pair trading, let's say you want to trade Microsoft against Google. The question is, well, how many shares of Google versus one share of Microsoft? And the typical way to find that out is to run a linear regression between, let's say, the prices, Microsoft versus Google. But in a trading strategy, you should only be able to use the past prices to run this linear regression. But a lot of traders forgot that, and they use all the data that they have between Google and Microsoft and determine the ideal hedge ratio, and then use that hedge ratio to feed into their pair trading strategy, maybe buy low, sell high, the spread. Well, that has already introduced look-ahead bias, because you wouldn't know that ideal hedge ratio unless you have all the data, including future data, used for the regression. So a proper backtest would use a rolling linear regression. The last data point would be, for example, today price, not tomorrow price, not the price the day after in the historical context. So look-ahead bias is sometimes can be very subtle, because of course nobody would be silly enough to say, oh, I'm going to deliberately use tomorrow price to decide whether we enter today. Nobody would be so foolish as to do that. But there are many other subtle ways that you can seep into your strategy, such as in determining the hedge ratio of a pair.
Do you find your models select more mean reversion strategies or momentum type strategies or some other?
It's not a question of selection. It's obviously, ideally, you would want to create a balance of the two types of strategy, because, like I mentioned, momentum strategy are long volatility. They are convex. They oftentimes have a negative beta relative to the market. Whereas mean reference strategy is short volatility. They are concave, and they oftentimes has a positive beta to the market index.
Let's take a quick break from the episode real quick to talk about automating all of your trading strategies. There are so many different tickers and symbols and opportunities every single day. It's impossible to compute it all as a human. So why don't you have a computer trading for you? I don't know. I'll teach you exactly how to algo trade at algotradecamp.com, step-by-step tutorials. I wasn't a coder before. You don't need to be a mathematician. You don't need to go to school for this. You're already ambitious enough to trade. Let's just automate that strategy so we can remove the emotion out of it.
And so you wanted to have the two running side by side or in some balanced mixture in a portfolio, so that you would have a market neutral mix, right? Zero beta. And secondly, if you think of their exposure to volatility, again, obviously the mean reversion strategy will have a negative loading to volatility, whereas momentum strategy has a positive loading, a positive exposure. So again, with respect to volatility risk, you also wanted to balance the two types of strategy so that you are market neutral with respect to market movement, and also neutral with respect to the volatility risk, and so forth. So it is not that we randomly find that we find more